The United States has just enacted a sweeping 35% tariff on a wide range of imported goods, a dramatic shift toward protectionism. This move marks a significant departure from the country's long-standing trade policies, which have traditionally favored open markets and free trade. The decision to impose such a high tariff is seen as a bold attempt to reshape the economic landscape, aiming to protect domestic industries from foreign competition. This is not a minor tweak. It's a historic reversal of decades spent lowering trade barriers. For years, the U.S. has been at the forefront of promoting global trade agreements, fostering international cooperation, and encouraging economic integration. The new tariff policy represents a stark contrast to these efforts, signaling a shift towards a more insular economic strategy. A tariff is a tax on imports, and at 35%, it's the highest in nearly a century. This substantial increase is expected to have far-reaching implications for both domestic and international markets. Importers will face higher costs, which may be passed on to consumers in the form of increased prices for goods. The policy impacts thousands of products, from cars to clothing, affecting millions of Americans. Consumers may find themselves paying more for everyday items, while businesses that rely on imported materials could see their profit margins squeezed. The ripple effects of this tariff will be felt across various sectors of the economy. The administration's goal make foreign goods pricier, pushing consumers and businesses to buy American. By incentivizing the purchase of domestically produced goods, the government hopes to stimulate local manufacturing and reduce the trade deficit. This strategy is part of a broader effort to revitalize American industry and create jobs within the country. President Trump argues this will protect U.S. industries, bring back jobs, and strengthen the nation's economic independence. He believes that by reducing reliance on foreign imports, the U.S. can regain its competitive edge and ensure a more stable economic future, and generate revenue for the Treasury. The additional funds collected from the tariffs are expected to bolster government finances, potentially allowing for increased investment in infrastructure and public services. For decades, global commerce has relied on freer trade and interconnected markets. This tariff challenges that foundation. The move has sparked concerns among international partners who fear it could lead to a breakdown in trade relations and trigger retaliatory measures. The U.S. is now prioritizing economic defense over global integration. This shift in focus reflects a growing sentiment of economic nationalism, where protecting domestic interests takes precedence over maintaining global alliances. The world is left to wonder, is this the end of an old trade war or the start of something much bigger? As countries grapple with the implications of the U.S. tariff, the potential for a new era of trade conflicts looms large. The international community is closely watching to see how this policy will unfold and what it means for the future of global trade. The consequences for the global economy are only beginning to unfold. As markets adjust to the new reality, businesses and consumers alike will need to navigate the challenges and opportunities that arise from this significant policy shift. The full impact of the tariff will become clearer in the months and years to come as the world adapts to a changing economic landscape. For American shoppers, the most immediate effect is higher prices. Everything from TVs to shoes will cost more. Companies pass the tariff's cost to consumers, stretching household budgets. The policy aims to make U.S. products more competitive, potentially boosting factory jobs. But many American manufacturers rely on imported parts, so their costs rise too. This could make U.S. goods pricier at home and abroad, hurting exports. The result? Winners and losers. Some industries may thrive, others struggle with higher costs. The intended logic is to shield domestic jobs, but the reality is a complex reshuffling of economic pressures. The overall impact will vary widely across sectors, states, and households. America's 35% tariff has sent shockwaves through export-dependent nations. This significant increase in tariffs has not only disrupted the flow of goods, but has also created a ripple effect across global markets. Exporters are now facing increased costs, which are being passed down the supply chain, affecting prices and availability of goods worldwide. Countries like Switzerland and Taiwan now face steep hurdles selling to the U.S., threatening jobs and industries. Factories that once thrived on American demand are now seeing orders dwindle, leading to potential layoffs and economic downturns. The impact is felt not just in the manufacturing sector, but also in the broader economy, as reduced exports lead to lower GDP growth. Governments are scrambling, seeking new markets and negotiating for relief. Diplomatic efforts are intensifying as countries look to forge new alliances and trade agreements that can offset the losses from the U.S. market. These negotiations are complex and time-consuming, often requiring significant concessions and strategic shifts. The tariff is also a political tool, with the U.S. threatening even higher duties for countries like India over their ties to Russia. This adds a layer of geopolitical tension, as countries must navigate the delicate balance between maintaining political alliances and protecting their economic interests. This weaponization of trade forces nations to weigh economic interests against political alliances. The stakes are high, as countries must decide whether to align with U.S. policies or seek alternative partnerships that may offer more favorable terms. Some may respond by forming new regional trade blocs, reducing reliance on the U.S. market. These blocs could provide a buffer against U.S. tariffs, allowing countries to trade more freely among themselves and develop new economic strategies that are less dependent on American consumers. The immediate goal is to punish unfair practices, but the long-term effect could be a world less centered on American consumers. As countries adapt to the new trade landscape, we may see a shift in global economic power, with emerging markets taking on a more prominent role in international trade. President Trump's rationale is simple: put American jobs and factories first. The administration sees the tariff as a way to fight decades of unfair competition and revive U.S. manufacturing. By making imports more expensive, the goal is to level the playing field and bring jobs back home. Reducing the trade deficit is another key aim, discouraging imports and boosting domestic production. This is economic nationalism in action, prioritizing American workers over global free trade. The tariff is framed as a necessary defense of U.S. economic sovereignty. It's a bold gamble that protectionism can restore American manufacturing might. Despite the headline rate, the tariff's rollout is full of negotiations and exemptions. The administration uses the threat of tariffs as leverage, striking deals with allies like the UK, Japan, and the EU to lower duties on key exports. Some industries and companies, especially those investing in U.S. manufacturing, receive exemptions. This selective approach reshapes global supply chains and rewards those who align with U.S. goals. For businesses, lobbying for exemptions is now as crucial as managing costs. Trade policy has become a high-stakes, ever-shifting game of deals. The 35% tariff is more than economic policy. It's a tool of American power. The administration uses tariffs to pressure countries on foreign policy, especially regarding Russia and the war in Ukraine. Nations like India face steeper duties if they continue certain alliances, tying trade directly to geopolitics. The tariff also aims to bring tech manufacturing, like semiconductors, back to the U.S., reducing reliance on Asia. Trade and foreign policy are now deeply intertwined. The U.S. uses tariffs to reward allies, punish adversaries, and secure critical industries. This marks a shift to a more transactional, confrontational global order. Countries must now align with Washington's agenda to maintain economic ties. Many feared the tariff would spark chaos in global markets, but the initial reaction was surprisingly calm. Investors had time to prepare, and strategic exemptions reassured key industries like tech. The administration's targeted approach helped contain financial fallout. Still, long-term uncertainty looms. Trade wars could slow growth and disrupt supply chains. Wall Street is in wait-and-see mode, watching for retaliation or escalation. The current calm may be temporary. The true impact will take months or years to emerge. As companies adapt and countries respond, the real cost of the tariff will become clear. For now, markets are steady, but the risk of a damaging trade conflict remains. The 35% tariff marks a profound shift in America's global role. For much of the 20th and early 21st centuries, the United States positioned itself as a leader in promoting open markets and international cooperation. This new policy signals a dramatic departure from that legacy, sending ripples through the global economy and challenging long-standing alliances. For decades, the U.S. championed free trade. Now it's embracing protectionism. This reversal is not just a change in economic policy. It's a statement about America's priorities and its willingness to put domestic interests above global partnerships. The move is being closely watched by both allies and competitors, who are recalibrating their own strategies in response. This risks alienating allies and could fragment the global economy. Countries that once relied on stable trade relations with the U.S. may now seek new partners, potentially leading to the formation of rival economic blocs. The sense of uncertainty is palpable at international summits, where leaders debate the future of global commerce. Retaliation is likely. Other countries may impose their own tariffs, sparking a trade war. Such tit-for-tat measures could escalate quickly, affecting everything from consumer prices to diplomatic relations. The specter of a prolonged trade conflict looms large, with ordinary citizens and businesses bracing for impact. U.S. exporters and workers could become casualties in a broader conflict. While some industries may benefit from increased protection, others, especially those reliant on global supply chains, face uncertainty and potential job losses. The economic pain could be felt in communities across the country. America's inward turn may be seen as a retreat from global leadership. As the U.S. steps back, its absence is felt in international forums and negotiations, raising questions about who will fill the void and set the rules for global trade. Other nations may form new alliances, reducing U.S. influence. Regional powers could seize the opportunity to strengthen their own economic ties, potentially sidelining American interests and reshaping the balance of power. The tariff could revitalize some U.S. industries, but it's a high-stakes gamble. While certain sectors may see short-term gains, the broader impact on innovation, competitiveness, and consumer choice remains uncertain. The long-term consequences will shape America's economy and its place in the world for years to come. Economists warn that the effects may be felt far beyond the immediate headlines, influencing investment, growth, and the nation's global standing. The world is watching to see if this historic pivot brings prosperity or isolation. As America redefines its role, the choices made today will echo for generations, determining whether the nation leads, follows, or stands alone on the world stage.